I want to bring in CNBC contributor Capital Area's Malcolm Ethridge into the conversation. Malcolm, how are you looking at just today's earnings as a bellwether of the latest in terms of the AI trade?
Hey, Leslie. Yeah, I think Dan just put it really well there in terms of us being in the third inning, early days of this particular game. But I think the question that the market is asking at this point is how long before viewers of that game change the channel? And I think that's what we have to be focused on right now. So we've been applauding the capex being spent. $725 billion is the estimate for 4 companies to be spending this year on capex related to the AI build out. And that's twice the number that they did last year. So where we were applauding them once upon a time for increasing guidance on what that spend was going to look like and extrapolating that out to the chips and everything else those dollars had to flow into, now I think those companies are going to be penalized one way or another, regardless of how they decide to tell that story. So if Alphabet, for example, starts to walk back some of the expectations for growing that capex number next year, or even says we may not actually need all of what we've built to this point, that is going to be very difficult for investors to decide to hang in there and see how the story ends, instead of the sell first, ask questions later mentality that we've been seeing play out again and again this year.
Yeah, there certainly does feel like, in terms of the personality of the market, more fragility around the trade overall. What do you think, Malcolm, is the number one number that you'll be watching after the market today?
Yeah, I think cloud growth for Google tells the story all on its own. So if Google Cloud does something like $22 billion or more, that'll satisfy what the street is looking for. That's the significant growth number year over year, 65% or so compared to last year's number. And I think that would help to tell the story for Google specifically about why they've been spending the money that they have been spending on building out AI-related infrastructure and where they can continue to monetize it. It also would go a long way to help tell the story for the other 4 companies, because you've got Meta that's been talking about maybe we overbuilt and we're going to have to turn some of this open to the open markets like Anthropic and others. You don't want to hear that same sentiment from Microsoft and then Amazon, because then that says that the overbuilding has already been acknowledged, and that tells a much different story for those 4 hyperscalers.
Right. Invesco's Brian Levitt is also with us. Brian, how are you thinking about just the overall importance of the hyperscalers these days, given what we've seen in terms of the momentum reversal, a little bit of a rebound yesterday? How important is tonight's report in terms of just the overall market sentiment right now?
Yeah, it's important for the entire AI trade. But if you look at the Magnificent Seven and how they've been trading, we were talking about how expectations had just gotten so high, and the market corrected around a lot of those names. Now, Google held in, but a lot of those names corrected. In fact, for the 3rd time in the last couple of years, the Magnificent Seven fell through the 200-day moving average and held and bounced higher. And, for the people who look at technicals, I think the important thing to look at there is the highs continue to be higher and the lows are higher. That's a structural bull market, and I expect it to continue, and I think the earnings season will confirm it.
Yeah, speaking about the earnings season, you've got a lot of profit guidance momentum. The S&P 500 companies raising their outlooks versus maintaining or cutting them has climbed to a record in Bloomberg intelligence data going back to 2011. What do you think that suggests about just the overall bar at this point in time as we get the first hyperscaler report later?
Listen, profit margins over the last 30 years have actually continuously gotten better for S&P companies. I think largely around technology efficiency. I don't think that the hyperscalers, their margins are going in the other direction right now. But I think the overall, to your point about the market, profit margins, like on a secular basis, are getting better. I think that the earnings of individual companies, we've already seen this, Leslie, with TSM, with individual companies, having earnings and then the stocks sell off because there was so much momentum in the charts. I think we've had a healthy correction. I do think it's important, though, with these hyperscalers and AI, everyone says we're in early innings. Well, I think you have to distinguish, and not to be bearish, but I do think about this. We're in very early innings of the technology build out. but it doesn't mean we're in the early innings of what's priced in. And so I do think where I think of that through is what's already priced in, and this is a long way to go, but we're going to get these air pockets in these areas. I do think from Google specifically and Amazon, when it reports, their spend is going to be a beneficiary to the memory names, to the semi names, to Dell, et cetera. So we could see a pickup back in those names as that capex is confirmed and they're spending the money to those other companies.
Yeah, I think what you said is a really important distinction, Bryn. It's not, we may be in the early innings of this overall build out, but in terms of what the market has priced in at this point, could be something different. So do you feel like the inning that we are in is potentially a more demanding phase of just the cycle?
Well, it's demanding for the spenders, right? Because they're just keep spending this money. We see who's profiting: the Dells, the SK Hynix, the Samsungs, et cetera, et cetera. So that trade has been very straightforward. I do think that these companies, we as the market, will, I think, continue to demand return on investment, and that's why Meta's doing the smart thing and selling their extra compute. That's why SpaceX is selling their extra compute. But everyone tells you that's in the know. We are compute constrained, and those companies just have their own issues around that, and everyone else is willing to buy that. So I think the market is from the build out. We are in the early innings, but I do think investors don't need to get ahead of themselves and do ask themselves on each individual companies what's actually already priced into the name.
What about what's already priced into inflation, Brian? The Fed has come out and said that all of his capex is partially to blame for some of the inflation that we're seeing. Do you agree with that? Is there anything that we could garner from the hyperscaler reports this week, next week, that could kind of support that thesis?
I'm not overly concerned about it. In fact, the bond market's expectations for inflation have come down amid some more hawkish talk from the Federal Reserve. So ultimately, I think that rates have gotten ahead of themselves. If I'm looking at a 10-year Treasury at 4.65 or a 30-year at over 5.10, to me that's a buying opportunity, and that's going to be part of a slowdown in economic activity that we're going to get as a result of energy costs going up again. So I'm not overly concerned from an inflation story. In fact, I would be in Kevin Warsh's camp that AI is ultimately deflationary. We'll have some supply challenges here and there, but human innovation will find its way through it. As far as the markets, the reality is, coming into the year, we were saying it's time to diversify into small caps. It's time to look outside the United States because the world was expanding and the Fed was going to cut interest rates, and that trade did very nicely. The hyperscalers have not performed well this year. In fact, we're just coming off some of these names 20-30% downturns. So in terms of the markets being too frothy on this, I think that's an earlier in the year story. Right now, I think these names are set up quite nicely.
But the Fed hasn't cut.
Fed has not cut, and the market's digested it. The market's gone from 3 rate cuts to maybe 2 hikes, and no incident in the credit markets. Ultimately, I think they're on hold, and I think in a slowdown, if gasoline prices stay elevated, they're going to be cutting rates in 2027.
And you got the broadening even without it.
We got the broadening without it.
Yet.